Research done by Momentum Alternative Investments has found that hedge funds can and do preserve capital during periods of market stress, and adding them to traditional portfolios offers significant benefits. Well, that's what they're supposed to do, and I suppose what they're saying is that we've done that. To talk more on this, we joined from our Cape Town studios Kris Adams, portfolio manager from Momentum Alternative Investments, fund of hedge funds. Hi, Kris.
Hi, and thanks for having me.
Kris, perhaps you can
just to give a bit of context.
Start off with just what your research has revealed.
Okay, well, just to give a bit of context, we've been running hedge fund money through fund of funds since January 99 in our offshore business. We started off managing local South African hedge fund assets in November 2007, and that was right at the top of the market. So we've seen the best of hedge funds, we've seen the worst of hedge funds, and the research that we've done has proved that hedge funds are not a homogeneous asset class. You need to drill down into what the underlying managers are doing in order to understand what kind of return payoff profile you can get.
Kris,
if you do that job properly, you're able to pick hedge funds that can make money when volatility rises. And that is how we spend all of our time, trying to find managers who can protect capital when the markets crash and hopefully make a bit of money as well.
Kris, I understand
the best way that
Kris, can you hear me?
Yeah.
Kris, can you just spend some time trying to explain fairly simply what is it that you guys do in order to dampen down that volatility? I mean, everybody, when they look at the market volatility, they'd love to see, markets going through less volatile, or their portfolio going through a less volatile time. What specific measures do you guys put in place to dampen it down?
Okay, well, it's all a function of the mandates that the managers are running and the strategies. Leverage can be used to amplify returns, but also it can be used to reduce risk. Now, I don't know if I need to go into the mechanics around short selling, but basically if you short sell a share, you can make money as the share price falls. So what a lot of these managers will do is build portfolios where they'll take hedged positions, so there might be long Anglos and short Billiton, in which case you're looking for your Anglos to outperform your Billiton. If even that can happen even in a falling market, as long as Billiton falls greater than Anglos. Now, if you look at the long-short equity managers in 2008, which was quite a very volatile period, we had a dispersion of hedge fund returns of about 50%. The top performing long-short managers that we follow were up around 35%, and the worst performing managers we follow were down 25%. So you can see there is a huge difference in the way that portfolios are constructed and the riskiness of the underlying strategies. Then you get certain strategies like quantitative strategies. They tend to be trend following systems, and they will be long or short depending on the current trend in the market. Now, the best performing fund we had in the quantitative space in 2008 was up 50%, and that's because they were short as the market was falling and then went long as the market was rising.
Kevin, you had another question for Kris?
Kris, how, from your perspective, do you think these strategies are well understood by investors? What has been the general attitude of the investor to hedge funds through the financial crisis? Is it something that they've generally been concerned about, and some of the risks that they think may be associated with hedge fund investing?
It depends which investors you're talking about. There were a lot of issues offshore about gating, side pocketing. A lot of credit investments were found to be a lot less liquid than they were thought to be. But if you constructed your portfolio correctly, you were able to minimize a lot of the damage. Now, locally, the hedge fund industry was held back by Reg 28, which used to have a prescribed limit of 2.5% to a section called Other, of which hedge funds were a part of that. Now, Reg 28 has increased the limit to 10% for hedge funds and 15% if you include private equity as well. This means that pension funds locally have had to increase the amount of attention they're paying and to improve their understanding of these strategies, because they do help dampen volatility over time, provided that you understand what the underlying managers are doing. Now, the industry has been around for about 8 to 10 years locally, and the managers are seasoned professionals. Unfortunately, their investors haven't always been totally up to speed with how they make money. But that is changing.
Isn't that one of the problems,
There's
Kris, is that the banks got a very bad name in the late 2000s for behaving badly and lending too much money to people that they shouldn't have. And the hedge funds were attacked for being non-transparent, for being too big, not too big to fail, but too big in the sense that they can make other things fail and we don't know what they're doing. Transparency an issue for investors as well as regulators?
Yeah, the local market is very transparent. On a daily basis, we get 100% transparency of the underlying positions. This is quite standard amongst hedge fund investments in South Africa. The managers are very open to discussing their strategies. They want you to understand what they're doing because they see it as a partnership. And then it's our duty to go back to the pension funds and try and improve their understanding of how the strategies work. But transparency is very good locally. We invest through the JSE managed account platform. I'm not sure if you know what that is, but it's a risk management mitigation tool run by the JSE. They do all the mandate compliance. They do all the reconciliations of the prime broker trades back to the administrators. It is a very secure way of investing money. They monitor mandate any breaches, limits. When a manager gets close to breaching a limit, there's an email. If the manager continues to breach limits, their trading rights are terminated. So it's actually quite a good way to invest money.